This is your anti-fiat gold, silver and Bitcoin price update for the week ending 2nd of October, so let's dive on in. I'm Miles Harris and this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Let's start by having a look at the gold and silver price, with gold closing out the week at just below $1,900, up nearly 2% on the week. Meanwhile, silver closed at $23.78 and was up almost 4% on the week. So let's now consider some of the wider macro drivers that can really contribute to higher prices for gold, silver, Bitcoin and so on. Starting with the Fed's balance sheet, which is still largely flat at just over $7 trillion. Meanwhile, the US deficit and debt continues to soar, while the dollar on the DXY index has moved downwards from its recent high of around 94.5 to close out at 93.8. This move in the dollar has certainly helped gold to recover some gains this week. Meanwhile, 10-year Treasury bills are yielding 0.68%, and WTI, which helps give us some insight towards likely inflation expectations, is down over 3% this week, as it seems to have dawned upon the market that any recovery is a long way off at the moment. The gold chart shows us that the price has moved back in line with the 50-day moving average, and the MACD indicator suggests we may be about to see an uptick in the price level. Key support levels remain this trend line, together with the major breakouts of around 1820 and the 200-day moving average at around 1750. Major resistance remains at around 1912, the 2011 high, and beyond that, of course, 2000. But if we zoom out and look at this over a 5-year period, we can see a slightly different story, suggesting the recent price growth may be becoming a little stretched, particularly because we are yet to see confirmation of further stimulus and the Fed's balance sheet remains flat. With oil prices remaining low, I'm not expecting any big jumps in the gold price unless we see some sort of external shock take place or massive dollar weakening. A sideways churn or a retest of those support levels seems entirely possible. On to silver, and we see much the same patterns playing out. Clearly holding $22 is absolutely key. Below that we can see support around $20, and then at these horizontal lines. Zooming out to a 5-year horizon, we can see just how profound the price rise has been and where we are in relation to the 50-week moving average. MACD appears to be favouring a further decline in prices. So what does the gold-silver ratio indicate? First, that we had a successful back test of the resistance at around 83.5 and are currently seeing a GSR of around 80. The MACD and stochastics seem to back this up, so it seems likely we may see a gradual softening in price, which could see a further retest of that support level of 83.5, 84. And are we about to see a stock market crash? Well, the risk on and risk off indicators we looked at in this video appear inconclusive. While we have seen a rise in the utilities ETF, our longer term Treasury bills ETF has seen price decline slightly. Remember, prior to the big crash in the early spring, we saw these two indicators greatly outperforming the SPX S&P 500 index. At the same time, gold prices were also rising. Clearly, risks of stock market crash appear to be growing, but not to the extent that we're likely to see real outperformance in the longer term treasuries against the wider S&P 500, at least not yet. As for Bitcoin, we've seen a record for the number of days the price has held beyond $10,000. But again, we see the momentum really slowing in our indicators here. Unless there's a big move to risk off assets, prices seem likely to churn sideways or come down slightly. But this is normal and entirely healthy for all of these anti-fiat markets. Some of the wider news stories this week have been around the decline in oil and copper prices, which represent the market's wider appreciation of just how dire the economic situation remains. Moreover, there's also been controversial stories emanating from China and the backgrounds of this wider crisis. In the UK, our Chancellor has even cancelled the autumn statement last week. So grim would the news have been. He couldn't bear himself to actually expose this to the public. So as I've said before, we're going to see more stimulus, and it will certainly be on its way before long. Now, I hope this has been useful. Thanks so much for watching. Do consider subscribing, and I look forward to seeing you next time. Bye-bye.